Well, the U.S. has been stripped of its top-tier credit status by Fitch Ratings, the downgrade from AAA to AA+, coming as a bit of a surprise. Fitch writing in a statement, the move, quote, reflects the expected fiscal deterioration over the next 3 years and credits, quote, erosion of governance and rising deficits as causes. For more on this, we turn to Jeanna Smialek, New York Times Federal Reserve and economy reporter and author of Limitless, which is about the Federal Reserve. Also with us, Kinahan, IG North America CEO. Thank you both for joining us. We appreciate it. Jeanna, I want to start with you. This did take some folks by surprise, even though Fitch had already put the U.S. economy on watch for a downgrade, or the U.S. government, I should say, on watch for a downgrade. What's the kind of reaction that you're hearing about this morning, and how are you sort of framing this?
Yeah, I think there's a little bit of confusion both among sort of policymakers in Washington and also among sort of the analyst class on Wall Street about why this happened now. Janet Yellen, the Treasury Secretary, called the timing a bit arbitrary. Clearly, the thing that has sort of caught Fitch's eye is some combination of political brinksmanship and the fact that the debt limit debates have been happening with just so much animosity over recent years, but also the fact that we have, such a big and growing debt burden and deficit expansion here in the United States. And so, I think the question that's kind of on everybody's minds is sort of why now? But, I think it may be a while before we have a very clear answer to that.
Jeanna brings up a great point, that point about why. It's not so much the why now, because this was signaled to come. So, what does this do to investor sentiment, in your opinion?
Well, it's interesting to see the market today. Yes, it's down, but we still continue on this streak. Coming into today, we had 47 consecutive days of trading days where we were down less than 1% on the S&P 500. We're flirting with that at the moment, I guess, on the back of just talking about Match.com. That makes sense. But overall, we still haven't gone down more than 1%. We do see a little bit, the VIX, up 10% today. So a little bit of concern there. But overall, I think the market, I won't say is ignoring it, but I certainly don't think you're seeing the kind of reaction you might have expected if overall the market was very panicked about this news.
Yeah, it seems that way, JJ. And I wonder if investors are more focused, their attention is more sharpened right up in the run up to, say, the debt ceiling debate, for example, which is what was linked to the last credit downgrade for the United States. So do you think there will be any sort of longer term effect in the market from this downgrade?
Well, I do think, the amount of debt we've taken on in a very short amount of time, at some point, we're going to have to reckon with that, if you will. But in the shorter term, at the end of the day, it's still earnings that drive markets. And we're in the middle of a really good earnings season overall. Coming into today, 83% of the stocks had beaten, albeit many of them on lower expectations. And as we're continuing to see, employment is staying strong. Obviously, on Friday, we'll get another reading on that. But from ADP this morning, it looks like this market has been incredible in terms of, think about where we started the year, think about all the bad predictions for everything that would happen all year. Very few people are calling for this kind of a rally. So this really has been an incredible case in resilience. That being said, again, debt is something that you do have to deal with at some point, and we're not exactly doing the best job at that at the moment.
So, Jeanna, this is a great pivot. So we have new numbers on jobs showing, ADP report showing 324,000 jobs added. When we think about last month, and certainly there was a difference, a divergence between ADP and the government's report. What does this do? I know you recently wrote about the soft landing scenario. What does this do for that possibility?
Yeah. So, the ADP numbers are really interesting because ADP revised how they calculate these numbers last August, so about a year ago now. And they don't tend to match super well with the government payrolls report, which is the one that we're about to get Friday, which is what Wall Street tends to pay more attention to. But what ADP does tell you is sort of the general direction of travel. And I think the general direction of travel here is a very good one. It seems like we are still doing a lot of hiring. Unemployment remains very low. People are coming back into the workforce in ways that we didn't expect. And all of that adds up to a situation where this economy has a lot of resilience, even as the Fed tries to slow it down. And so we have seen some of that slowdown that was meant to happen, that was engineered, but we haven't seen a huge cracking in the economy that would plunge us into recession at this point. And so I think in general, it's been a very good news story recently.
You also wrote recently, Jeanna, about the soft landing optimism, which you're expressing, but that we have seen soft landing optimism in the past, and it hasn't insulated the economy from a recession. So how do we know that that's not going to happen this time?
Yeah, so it was funny. I was talking to Gennady Goldberg, who's a strategist at TD recently, about sort of all the soft landing optimism. And he was telling me, it's funny if you go back and look at the clips from the last couple of recessions, right before those recessions happened, people were calling for soft landings. And so, of course, I did that. And I went back and sort of climbed through the New York Times archives. And it is true that before all three of the last recessions, people were very confidently saying, we've achieved victory and we are not going to have a recession. And that this is the mythical soft landing. And so I think it's just a real reason for humility. Like, it's clearly the case that it often seems like you've nailed it right before you plunge into recession. And so I think that's a reason to avoid being too confident about any forecasts at this stage.
JJ, I want to ask you about your clients. Are they playing this market as if there is a recession in the cards, or is it kind of out the window now?
No, I think people have been pretty optimistic. Gina's point, I mean, as they say, you get knocked out by the punch you don't see. But right now, it is a little bit difficult to see that we are headed to recession. With that said, if I look at our clients, obviously, you see elevated activity as you would expect in Apple, Tesla, Nvidia, as this market has climbed up. What's been really surprising to me is two major trends that we've seen. The first one, if I go back 2 months ago, what we were seeing a lot of is our clients, and before that, trading indexes and index ETFs, be that through equities or options. What we've seen over the last 2 months is more belief in the rally as we started to see many more single names. So we went from almost a 50% index trading to back down to a more historical 30 to 35%. The rest going to individual names. I named some of the three there, but the two that have been the most interesting to me over the last 3 weeks have been Microsoft, where we've seen 75% more trade in that period, and Netflix, which has really been amazing, where we've seen 125% more trade in the last 3 weeks. So those two names particularly have seen a lot more bullish activity. They performed well overall. But along with that, we started to see it spread out a little bit more in terms of the individual names besides those, many are calling the Magnificent Seven, onto, some of the energy names, et cetera. So I think it's a really healthy sign for the market overall when people are starting to spread out their investments a little bit more. When people are very unsure is when they go to the index-based trading. The fact that we're starting to see more normalized trading, to me, is a very good sign.
On the flip side, JJ, what we're also seeing today is a decline in those very same tech stocks that people have been getting into. And I just saw a headline that the 10-year yield is now at its highest since November at 4.09%. Whether it's because of the downgrade or other factors, how much of a headwind are we going to see that come back as a big headwind for big tech?
You could, but, again, keep in mind where we started. When you have this many, we've had an incredible rally. We haven't had any real sell-off in over a month. Part of I actually think it's always healthy when you get a little bit of a sell-off after these run-ups, because the longer you go without one, the more drastic that sell-off tends to be. So I don't think that's necessarily a bad thing. I do think, though, in terms of relating that 10-year to inflation, et cetera, if you look at the yield curve, we still have that 2-year over the 10-year. And in my opinion, for us to really say, okay, we have a chance to have a great rally, we're going to have to see a normalized yield curve, because what that will allow is for the financials to truly participate. Yes, higher interest rates are good for financials, but again, when you have that shorter term rate over the longer term rate, it's not to the place where you want for them to truly perform.
And then finally, Jeanna, to circle back around here, with this Fitch downgrade happening, Any chance of DC taking notice and getting along better and getting stuff done? I'm laughing, but I got to ask the question.
It's a fair question. No, I think the answer to that is basically a negative. Pretty much every economist note that I've read today says basically the upshot of this is nothing changes. It doesn't add new information that we didn't previously know. It doesn't put enough new pressure on the political sphere to actually sort of change anybody's positioning. And I think we kind of saw that last night, after this downgrade happened. You saw some commentary rolling in from the Democrats and the Republicans, and they blamed each other for it. And I think that's basically where we are.
I wonder what actually would put pressure on them. Maybe we'll never find out. I don't know. Jeanna Smialek, thank you so much from the New York Times, and JJ Kinahan of IG. Thank you so much, guys. Good to see you.